Good morning and welcome back to the Market Analysis Desk. We're looking at FUBO, ticker symbol FUBO, trading right now at approximately $4.38, showing a healthy gain of just over 4% for the day. That's a significant move, especially when you consider the volatility this stock is known for. Now, on the surface, this looks like a straightforward bounce, a bit of a recovery after some recent dips. But the real story here is not in the intraday movement itself, it's in the underlying volume. We're seeing a substantial surge in trading activity that goes well beyond what you'd expect from a normal day's price swing. This isn't just retail investors chasing a green candle. There appears to be some significant institutional interest or a large block trade that is quietly driving this momentum. The question is, what are they seeing that the rest of the market might be missing? And does this signal a more sustained shift in the narrative for FUBO? The common market expectation for FUBO has been a story of a cash-burning growth company perpetually in a race against time. The narrative is simple. They need to acquire subscribers faster than they burn through capital to achieve profitability. This has made it a stock for those with a high tolerance for risk, often a speculative play in the online investment space. People look at FUBO and they see a small fish in a very big pond, competing with giants like Alphabet's YouTube TV, Disney's Hulu Live TV, and the legacy cable companies. The general sentiment is that while they have a loyal, sports-focused user base, their content acquisition costs and marketing expenses are simply too high to ever be sustainable. It's the classic growth versus profitability tension. This stock isn't usually something you see in a Schwab Intelligent portfolio or a conservative Fidelity account. It's the kind of thing that attracts individual brokerage accounts and active traders on platforms like FUBO Stock Trading. However, this deeper look at the recent volume action and the way the stock is behaving suggests a different angle. The reality might be that the market's focus on the P&L statement is blinding it to other, more tangible developments within the company's operational strategy. This isn't about an earnings report that happened last quarter. This is about what's happening right now, in the guts of the trading day. The expectation of a slow, predictable grind is being challenged by the reality of aggressive trading activity, a dynamic that points to something more than just a passing headline. To fully grasp this, we have to look at the recent trading history. FUBO has been a bet-grund stock for a long time. Over the past few weeks, it has traded within a relatively tight range, oscillating between $4.10 and $4.50. This kind of consolidation often precedes a larger move, and today's volume spike could be the trigger. The institutional trading platforms and some of the more sophisticated online investment sites would have flagged this volume surge immediately. This isn't a small uptick, it's a clear break from the recent average. You have to consider who is on the other side of these trades. Is it a fund building a position, or a short seller covering their bet? The elevated volume on an up day, coupled with a notable lack of any major news, is a classic sign of accumulation. Someone with a lot of capital is buying up shares without creating a major splash, suggesting they believe the current valuation doesn't reflect the company's true worth. This kind of trading behavior is a powerful counter-narrative to the prevailing pessimism. You'll see this kind of activity on professional platforms like Interactive Brokers Trading, where sophisticated investors are placing large orders that don't immediately hit the public news feed. This is not about the latest headline. It's about the conviction of a large player. Now, let's take a step back and talk about what FUBO actually does for those who might be less familiar. At its core, FUBO is a live television streaming service. What makes it unique is its self-described sports-first approach. They built their platform and their channel lineup around catering to sports enthusiasts, offering a wide array of live sports channels that appeal to that specific demographic. The company generates revenue primarily through two channels: subscription fees from their customers and advertising revenue. They've been very active in expanding their content portfolio, adding more sports leagues and channels to attract and retain subscribers. This business model is a high-stakes one because the cost of acquiring live sports content is incredibly high. Unlike a service like Netflix that produces its own content, FUBO has to pay substantial carriage fees to distribute content from networks like ESPN, Fox, and others. This is a major headwind for profitability and a key reason for the market's skepticism. However, they have been working on diversifying their revenue streams, notably through a push into sports wagering and an integrated ad tech platform, which are seen as potential avenues to improve their gross margins over time. This push into wagering is a significant part of their long-term strategy, aiming to create a more sticky and profitable user experience. The business model is a tightrope walk, balancing subscriber growth with controlling content costs and generating enough ad revenue to get to a positive cash flow position. This is a core part of the bull and bear case for the stock. Looking to the future, the outlook for FuboTV is complex and filled with potential catalysts and risks. On the positive side, a major catalyst would be reaching profitability, or at least a clear and sustained path to it, as a result of their advertising and betting initiatives. A strong earnings report that shows a significant improvement in subscriber churn or a meaningful increase in average revenue per user could be a powerful driver. You could see an event like this change the whole market narrative overnight, causing a short squeeze as bears rush to cover their positions. The company has also been working on international expansion, which could open up new markets and revenue streams. We've seen some of these smaller plays attract attention from platforms like FUBO Invest, which cater to a younger, more tech-savvy investor who is willing to take on more risk for potential growth. The company's ability to secure exclusive rights to a major league in a key market could also be a huge win, especially if they can do it at a manageable cost. On the risk side, the company faces intense competition, not just from other streamers, but also from the legacy cable providers that are still fighting to hold onto their customers. Any increase in content costs or a slowdown in subscriber growth could be disastrous. The macroeconomic environment also plays a role. If a recession hits, consumer spending on discretionary services like streaming could decline, putting pressure on FUBO's subscription revenue. The other major risk is the ongoing challenge of a high debt load and the need for more capital in the future, which could lead to share dilution and put downward pressure on the stock price. This is a dynamic situation, and the way the company navigates these challenges will define its future. This is a situation where investment help and self-investing skills are both tested. It's not a stock you blindly buy. It requires constant attention to the details. The tension between expectation and reality for FuboTV is exactly what makes this stock so interesting. The expectation is that it is a small, struggling company perpetually on the verge of collapse, a high-risk gamble that should be avoided by most. The reality, however, is that there are significant underlying currents at play. The recent volume action, the strategic shifts in their business model toward higher-margin revenue streams, and a loyal sports-first customer base all paint a picture that is more nuanced than the simple, cash-burning company narrative. It forces a question. Are the institutional buyers seeing a long-term plan coming to fruition, one that will finally put this company on a path to sustained success? The truth is, the story is still being written. The next few quarters will be critical in determining whether FUBO can move beyond being a speculative trade and become a legitimate player in the streaming world. For anyone who follows this stock, you have to be vigilant. This isn't a set it and forget it kind of investment. It's an active situation where the story changes with every move. Do you think FuboTV can successfully pivot to profitability through its ad tech and wagering businesses? Or are they destined to remain a growth story that never quite delivers? Comment below with your thoughts and predictions. Ultimately, FuboTV is a textbook example of how the market's focus on one narrative can sometimes miss a more complex and potentially more compelling reality.